Welcome to current federal tax developments for the week of May the 29th, 2018. Current federal tax developments are brought to you by Kaplan Professional Education and by your state society of CPAs. I'm Ed Zollers, broadcasting this week from Phoenix, and we'll be bringing you some of the discussions related to what's been happening this week in the area of taxes. And some of the things we're going to have this week, we had a case involving an FBAR penalty that took the IRS, actually took Treasury to task for not updating the regulations and limited the amount of penalties due to that fact. We had a question of whether a taxpayer had actually started a business yet, and if the taxpayer hadn't, why that would be a problem in terms of being able to claim current deductions. The big news of the week came out when the IRS issued a notice saying we're going to issue guidance on the deductions for state and local taxes, and specifically took aim at some of the workarounds we've seen. We'll talk about why that's not just necessarily a problem for those people who have clients in the 3 states so far to adopt workarounds, but also why it may spill over into other areas. In fact, we have a threat already by the New Jersey Attorney General to make it spill into other areas. And finally, we'll talk about the DC Circuit, which now has agreed with the 9th Circuit on the validity of the IRS's position regarding what happens if you have a disregarded entity as a partner in a partnership, and the impact on that on being able to qualify as a small partnership under TEFRA. This has an impact, even though TEFRA is going away, because the same problem is going to rear its head under the new centralized partnership audit regimes, or CPAR audits. So we'll talk about that background as well. Let's go on, though, then, and start talking about our first case of the week. This week, we're going to talk about the case of United States versus Colliot, case number 1:16.CV.01281. It's a case from the Western District of Texas, Federal District Court, and it was decided on May the 16th of 2018. Now, this is an interesting case because effectively the taxpayer now is admitting that he had willingly failed to report counts on an FBAR form. So you have a taxpayer here who now has admitted that, yeah, that whole FBAR reporting thing I should have done, kind of said didn't do it. But the question came then, what would the penalty be? Now, the actual penalty, this is what confuses some people about handling things like FBAR and when you look for Circular 230. The FBAR rules are not in the Internal Revenue Code. They're found not in Title 26, which is where the Internal Revenue Code resides in the U.S. Code, but in Title 31, which is where the other Treasury aspects find. In fact, at Title 31, Section 5321A5. In 2004, Congress changed the law. They changed the law to up the potential maximum penalty. And in this case, they basically swapped the law so that in a willful violation, the maximum penalty is the greater of $100,000 or 50% of the amount determined to be the max balance in the account. Now, it said the maximum penalty shall be this. Prior to this, the rules were much lower. In fact, $100,000 was the maximum penalty, or the amount in the account at the time of the violation. That would be the issue, or $25,000. So the amount not to exceed $100,000, or $25,000 were your limits. The Treasury, even though now they've delegated enforcing this to the IRS, the Treasury never got around since 2004 to changing the regulations. The regulations, which were issued back in 1987, still talk about that old limit on penalty. The penalty shall be no more than $100,000, or the balance account time of the penalty, or $100,000, whichever is less, or $25,000 if that's more than what was in the account. And in this case, the taxpayer's balancing account was well above $200,000, so the penalties would be well above $100,000. The IRS attempted to assess the $100,000. The court said, the taxpayer said, no. You guys, listen, your max penalty per your reg is only $100,000 for each of these accounts, so you can't take any more than $100,000. The Treasury said, yeah, but that was regulations under the old law. And Congress in 2004 removed those rules because these rules basically parroted the law before the 2004 changes. And so those regs are invalidated. Well, the court said, not so fast, government. Here's your problem. The code itself said these new limits are maximum penalties. Therefore, the Treasury has the discretion to apply a lower penalty if they wish to. And because of that, the regulation which prescribes a lower penalty will still be held to be the actual governing rule. In essence, saying the penalty can be as much as half of the balance in the account is not inconsistent with a regulation that says, well, the penalty we're going to apply will be no more than 100 grand. So because of that, the court found that, oh yeah, he's still subject to the penalty. And oh yeah, he's still got problems, but those problems are going to be limited to 100,000 per account rather than the 1/2 of the balance in the account, which for this taxpayer was a significant difference. Obviously, if the IRS believes that other courts will follow this view, and they very well might. Now, I admit it is a Western District of Texas case. That means a district court case, which is where these will be heard. But also means it's appealable to the Fifth Circuit. The Fifth Circuit is known to be relatively taxpayer friendly generally. So it might not be surprising if the IRS lets this lie and then sees if a court in another circuit that may be a little more IRS friendly accepts the same rule, or if a taxpayer in one of those other circuits tries to take the case up and sees what happens. Obviously, if the IRS begins to believe that, this is going to cause a problem, don't be surprised if Treasury doesn't start a regulation project to go ahead and update the regs to the 2004 balance. But it's interesting because what the court held was very simply, a reg doesn't get repealed unless a law is enacted that is at odds with it. The court said, we don't have to read the law Congress enacted as that law with its reg. And if the law is not at odds with the reg, then the IRS has to go through a formal process to remove the reg and update it. They can't simply go along with the new law if using the reg would still be in line with how the law is written. Again, in most cases, that won't be the case. But in this particular case, you can see how the court came to that decision. Next up, this is the case of Samadi versus Commissioner, Tax Court Summary Opinion 2018-27, issued on May the 24th of 2018. In this particular case, we have a taxpayer, and the taxpayer went out and became licensed as a real estate broker. And he and some relatives, acquaintances, decided that they were going to get together. And their theory was that they would find properties in the San Jose area that the taxpayer and they would improve and flip. So they were going to go into home flipping. We all remember home flipping, right? That was a big thing for a while, and now it's beginning to come back some. And so these taxpayers were thinking they were going to get into it. So they went out, found that particular. Now, what this taxpayer would do is every weekend from January through August, not sure why the end of the year he didn't do it, but he didn't. But January through August for 2 consecutive years, he would drive down from San Jose about 130 miles to where his relative lived, his brother-in-law, and he would pick up either his brother-in-law or one of the other investors, drive them back to San Jose. They would look at properties in San Jose, and then at the end of the day, he would drive them back to San Jose or drive them back from San Jose and then go back home. So this guy's rounding up about $500 or $500 miles every weekend in travel, going down to pick up the other investors, bring them to Santa Fe, San Jose, and then take them back from San Jose back to where they lived. Well, he tried to claim all of this as auto expense, saying that, look, this was expenses related to our business. However, there was a problem. They never actually acquired any property. They kept rejecting everyone they looked at. They couldn't agree they wanted that property. Now, Mr. Samadi said, but I'm a licensed real estate agent. And obviously showing properties to potential buyers is what a real estate agent does. And the tax court said, okay, first, not so fast on that. The first thing is, you actually have never started a real estate sales business. The fact that you're a licensed real estate agent in the state of California does not by itself mean you are in the business of being a real estate agent, because real estate agents close sales and get commissions. Mr. Samadi had not received any commissions in either of the years in question. In fact, we don't have any evidence in this case that he really ever received any commissions from anybody for selling a property. He had the license, but he never actually closed the sale. And we don't even have a whole lot of discussion about whether he ever actually showed properties to anybody else. So the court said, no, it's not part of your real estate sales business because you don't have that business. It doesn't exist. Well, there's still the flipping home business. Don't I have that? And isn't this part of that? I mean, obviously, to flip homes, one of the things you do when you're in the home flipping business is you go out, you look at properties because you're finding properties to acquire. And the court said, here's your problem. You never actually acquired any. You're not really flipping homes until you actually start doing the work to flip a home. And it could be a very different issue if, let's say, we had flipped, we had a series of homes, we flipped a bunch of them. And then if we had a dry spell, well, that's okay. The business already started. But in this case, the business had never actually started. When a business has not started yet, no deductions are allowed. Merely investigating a business is not a business. And investigating the business will end up with a bunch of capitalized expenses, and these capitalized expenses will not be deductible until such time as the business actually starts. Mr. Samadi had never actually started a business. And because of that, he can't claim any deductions. Now, if he had actually started the business, we'd have been looking under Section 195 for startup expenses. And those of you who recall there, you're going to get a chance to expense some of them if you don't have more than a maximum amount of startup expenses. You can expense up to $5,000. You then have to amortize the rest over 180 months. But if your expenses get above 50, you begin to be losing part of that original expensing. So again, you may be, amortizing these over 180 months. But in his case, you don't have to worry about that. The court also noted, we're not even going to deal with whether his auto mileage records are good and whether these are really business trips. And they said none of that matters because we don't yet have an operating trade or business. So those other issues are irrelevant. If he actually starts a business, then we'll go back and discuss whether these trips are actually business related or not. And, we'll deal with it from that standpoint. But IRS, don't worry about that side of it yet because it just frankly doesn't matter. Now, the big news this week came out of Notice 2018-54, issued on 5/23, basically May 23rd. And what this notice is it is a notice that is, a notice that says we're going to give regulations. It doesn't really tell us for sure what's going to be in them, but it tells them we are going to be issuing regulations. Specifically, we're going to be issuing regulations to deal with the state and local tax workarounds. As the IRS says in this notice, they become aware that a number of states, imagine that, we've discussed it here the last few weeks, have enacted various programs to attempt to work around the $10,000 limitations. And the theory of those, as the IRS points out, this particular notice limits itself discussing one particular attack that the states are trying to use to get around the limit, where the state sets up a charitable contribution fund. Contributions to that fund will generate in theory, a deduction to the taxpayers, a charitable contribution, and then the state is going to give a credit to the taxpayer for making that contribution. In the case of some of the states, it's either 85% or 90% of what you contributed, depending upon which state we're talking about. We have a couple of different percentages with a couple of different states here. The states so far that have adopted these rules have been New Jersey, New York, and Connecticut. The IRS says, despite these state efforts to circumvent the new statutory limitations on state and local tax deductions, taxpayers should be mindful that federal law controls the proper characterizations of payment for federal income tax purposes. You might suggest that indicates that the service might not like this. Well, specifically, the statement goes on in Section 3 to say that the Treasury and the IRS intend to propose regulations addressing the federal income tax treatment of transfers to funds controlled by state, local governments, or other state-specified transferees that the transferor can treat in whole or in part as satisfying state and local tax obligations. The proposed regulations will make clear that the requirements of the Internal Revenue Code, informed by substance over form principles, govern the federal income tax treatment of such transferred. The proposed regulations will assist taxpayers in understanding the relationship between the federal charitable contribution deduction and the new statutory limitations on the deduction for state and local tax payments. As you might guess, that sounds not good for those workarounds. And it isn't, except the New York Attorney General fired back a letter almost immediately. And this is where those of you not in those three states probably need to start listening, at least most of you. New York Attorney General sent a letter to the IRS, as you might guess, disagreeing with their view that this is going to be some sort of workaround. Well, specifically warned them that, they need to be careful issuing regulations here. They need to make sure that understand that over 30 states already have credits on the book that give taxpayers a full deduction, a full credit for amounts paid to various organizations specified by the state as being eligible to receive money that will generate the credit. And New Jersey indicated that, they would probably raise objections if somehow the IRS tried to work this so that only these particular ones that have been enacted recently were affected by this and the other 30 states didn't work. In essence, they're saying, why is ours different from theirs? Now, those of you listening here, you have a whole bunch of different theirs that are in that mix. Those of you in New Jersey, Connecticut, New York, of course, we've got this whole issue separate. But those of us in the other states, you've got a whole lot of theirs issues. This is an area of concern. Why? Remember, the IRS talked about not just funds controlled by state and local governments, but other state-specified transferees. If you may remember, back in 2011, we discussed the Chief Counsel advice that was issued that basically kind of gave a pass, or at least has been interpreted by almost all of us, as giving a pass to those credits in the 30 states. It was talking about a specific set of 5 credits in a specific situation. There's also been some private letter rulings. But that particular ruling said, well, yeah, we understand that you give $1,000 to this charity and you reduce your state taxes by $1,000. But we don't consider state tax benefits in determining if you got if you had a real charitable intent or made any real contribution. The theory being that while normally we'd worry if you give $1,000 to a charity and they give you something worth $300, or you receive from any other entity something worth $300, then you're deemed to have given $700 to the charity, not $1,000. But as that Chief Counsel advice notes, when you make a charitable contribution, by definition, you're going to reduce taxes. You reduce your federal tax by your marginal rate, you reduce your state tax by the marginal rate. And they went back and pointed out a series of cases that had said, yeah, we're going to ignore that benefit of the deduction. And that particular Chief Counsel advice said, well, we're going to expand that to say we just ignore state benefits. Now, it did have that provision, which you'll find if you read it, that talks about, well, there may be cases where this, where this credit is just obviously just a way of paying state taxes, but it doesn't tell us what the dividing line is. The challenge in this case is going to be in the proposed regulations. Does the IRS try to give us that dividing line? My guess is for the regulations not to be impermissibly vague. One of the real complaints, that we had, we had former Justice Scalia used to rail quite often about, rules that didn't let you know how in the world do you know if you violated the law. Rules need to be clear. The point of this is to have clear guidance on when we do and when we don't violate the law. Presuming that the IRS therefore issues a reg that gives clear guidance, there's going to be some concern that there could be collateral damage, meaning that some credits that previously have been allowed previously haven't been challenged. Maybe we should change the way we word that, because the IRS will claim the law didn't change, right? It didn't really change. But that have previously not been challenged may now suddenly fall under this regulation, no longer qualify. Keep a very close eye on these proposed regs when they come out, unless you're in one of the few states that is not one of the 3 that just enacted the workaround and has an income tax and is not one of the 30 plus states that already had something of this sort. If your state has some sort of 100% credit option or close to 100% credit option, you want to be very careful watching how they define in these proposed regs what is a permissible versus a non-permissible credit structure. That's going to be an interesting watch. Certainly, we expect litigation. In fact, New Jersey, pretty much the AG has already said that if he doesn't like the regs, and I think we can say there's two things I think that are very sure bets. Number one, the IRS is going to propose a reg that is going to wipe out the New Jersey credit. And number two, the New Jersey AG won't like it. And that the New Jersey AG will try to go to court to challenge the IRS on that regulation as soon as the IRS tries to take it final. So, a couple of things you can bet on right now pretty solidly. So, assuming those are both true, the problem is watching what comes up, how they work it, and then finally, how any court case moves forward. So, in any event, keep your eye on it. Note, there's also a very real possibility that we're going to see other states like, Illinois had a mechanism moving through their legislature to try to deal with this. California may still try something. We'll probably see a couple of other states that may take their own shots at this. So this could be a very interesting run. So keep your eye on this. This whole bit, that old chief counsel advice, what I find amusing is in that chief counsel advice, they specifically said that they weren't issuing, they decided against issuing guidance on, charitable contribution versus state tax. They decided not to issue formal guidance. Now they're going to have to go down that route. So what they decided not to do in 2011, they're going to be doing now. So we need to take a close look at what happens there. Next up, we have the case of Mellow Partners versus Commissioner, case number 16-1454. This is a Court of Appeals case from the Court of Appeals for the District of Columbia. So that is, it's going to be a DC district case. It was issued on May the 22nd, 2018. Now, just to clear up one thing, you might think Mellow Partners, these are laid back guys. No, that's actually based on the names of the two individuals, the last names of them, the first three letters of the last name of each individual. So that's how we get Mellow Partners. But the individuals in Mellow Partners held their interest in the partnership in single member LLCs. Now, you may remember that this is under the TEFRA rules. Under the TEFRA rules, if you're a qualifying small partnership and a partnership with two partners, both of whom are individuals, would be a qualifying small partnership, you are not under the TEFRA rules unless you elect to come in. For various reasons, and it basically has to deal with the statute in this case. If, in fact, they're not under TEFRA, the IRS is too late and will not be able to audit them, basically get money from them. If they are, the question is, in this case, are they under the TEFRA statute? Well, they're saying, look, single member LLC, disregard entity. We disregard it for tax purposes, so we treat the assets as owned by the individuals. Therefore, the partnership is treated as owned by me, and because of that, that's two individuals. Aha, we have a small partnership, a qualifying small partnership. We never elected to come under the TEFRA rules. So IRS, tough luck, you're too late. The IRS said, wait, no. A number of years ago, this is back, we ended up issuing a revenue ruling a number of years ago that essentially said that if you are a single member LLC, this revenue ruling 2004-88, if you're a partnership and if your partner holds their interest in a disregarded entity, which would include a single member LLC or a grantor trust, 100% grantor trust, where 100% of the assets are owned by the grantor, that's still a pass-through entity, which is what the code says cannot be a small partnership. And because those are pass-through entities, it disqualifies you from the small partnership treatment. Well, of course, the taxpayer said, wait. Under the regs, you told us that this was good for everything under the code. What do you mean we're not a small partnership now? It's held by individuals. The Ninth Circuit had previously ruled in a case we talked about earlier that, that in fact, the IRS's position on this, as stated in that revenue procedure, is valid. That in fact, you really can't, you can't take the position. That old Ninth Circuit case was Seaview Trading versus Commissioner from last year, 858 F 3rd, page 1281. That particular case said, yeah, sorry, IRS is right. It's a pass-through entity. The DC Circuit, analyzing this case, looking at what the Ninth Circuit said, and considering other options, said, you know what? We agree. This thing is still a pass-through entity as the law refers to it. And, the IRS position is not an unreasonable position given what the law states. And even though we ignore it for all purposes don't include this purpose. And for this purpose, this thing is still under TEFRA because it is a state-recognized pass-through entity. This entity is going to cause you to come under the TEFRA rules. Now, some of you are saying, well, who cares about this? TEFRA, I've already completed my partnership return for this past year. That's my last TEFRA exposed entity. We're now under the new centralized partnership audit rules, or what's now getting the CPAR or CPAR treatment. We need a good acronym, right? And so you always have to wait for the acronym. It appears we're now settling on CPAR as our acronym. So we're under the CPAR rules, right? So, the TEFRA rules don't matter. But the catch is the same issue applies under the CPAR rules. In the CPAR, under CPAR, in regulation 3016221B dash 1, that's 1B3, which, by the way, interestingly enough, that's the only final regulation sets we've gotten under CPAR so far. But we have this one. If an entity holds, if any of the partners in the partnership are a trust, and it did not exclude grantor trust, or a disregarded entity, the partnership cannot elect out of CPAR. Remember, under CPAR, all partnerships are in, but if you qualify, you can opt out of CPAR. So, given that the courts, now we have two different circuits on opposite ends of the country that have come to the same conclusion that these regulations are valid, that, the IRS position is valid under TEFRA, where the law made it less clear, under CPAR, when Congress passed that back in 2015, the Blue Book made it pretty clear the IRS had the authority to include these entities or not. It's up to them. The IRS has decided those entities are not going to be able to opt out. I have a feeling that's going to hold up the challenge as well. In any event, as I say, when you look at your entities, you look at your partnerships, and if you were thinking a lot of your partnerships, we'll just opt out because I'm a small practice. My partnerships are all owned by individuals, so who cares? The individuals are the only shareholders, the only owners. Be careful. Lots of those shareholders have set up, they might have set up single member LLCs to hold their interest. They might have set up, which we see quite a lot for estate planning, revocable living trusts, which are treated as one grantor trust. And those also cause you a problem under both TEFRA and CPAR. So, as I say, if you thought all your partnerships were getting out of the CPAR audits because you're just going to opt out on everything, take a look at this case and then take a look at those regs. And I think you're going to find that you have reason for concern. Well, coming up on this week, for those of you out there, I'll be seeing some of you in Phoenix and then some of you in Albuquerque. I'll be teaching the same course. It's on the Qualified Small Business, the Section 199 Cap A, deduction, and other business-related issues under the Tax Cuts and Jobs Act. So we're going to talk about where we stand on things like entertainment expenses. We're going to look at the new bonus depreciation rules, take a look at the small business accounting method issues, all these neat things we're working with in our business clients now in planning. So I've got that in both Phoenix on Wednesday, Albuquerque on Thursday, and they're both at the State Society offices. The one in Phoenix is webcast, so that one you don't have to make the Phoenix office. In Albuquerque, you need to make it to the office in Albuquerque to take the course. But if you're available, I'd love to see you there. Otherwise, check your State Society catalogs. There are courses like this going on all over the nation, and obviously getting up to speed on what's happening with the Tax Cuts and Jobs Act and being able to hopefully answer some of your clients' questions is a big deal. If you've looked at recent coverage, it's become pretty clear that most small businesses really don't know what's in that bill. They vaguely think maybe it helps them, but they're not sure. There's a lot of work we need to do to educate our clients about how this bill impacts them and what they can do to take advantage of it, or what exposures. There are some gotchas in here, even for businesses, that they might run into. So you want to make sure you get up to speed and then talk with your clients. As I said, we're offering the courses here on qualified small business. You're going to see a bunch of other options. Take a look at your state society catalogs, and you might want to go have a nice day. This is when it's really wonderful to be live in a live course with people in the room, because this is one of those things where we got a lot of these things to try to figure out, where everybody in the room can help figure out what in the world are we doing? How are we going to approach this? You'll see a bunch of ideas. Interesting thing to go and see. This will be, as I said, this week's current federal tax developments. The updates that I post during the week are at the website, currentfederaltaxdevelopments.com. So if you want to see the articles as things go up, you'll go there. If you have any questions or comments, you can email me, Ed Zollers at currentfederaltaxdevelopments.com. You can follow me on Twitter. There I post at Ed Zollers. I post mainly the updates, but from time to time I'll post other things related to, I like to post IT security things. So I think we need to be concerned about that. We also sometimes will post, if I get an IRS, if the IRS releases something big, I will normally post a direct link there before I get things written up on the website. So you can follow it there and get that information when it comes out. I also follow discussions on a couple of boards. One that's open to everybody. If you go to the Tax Pros subreddit on Reddit, reddit.com/r/taxpro, Tax Pros, I should say, that's with an S. I go on there. We've been talking there about some of the things. Had a pretty good discussion this week, too, about the implication of the IRS notice on state and local taxes. Also, I post information. We have some discussions on the California Society of CPAs Tax Talk website or discussion group. That is a Yahoo group that is open to basically to CPAs and attorneys that are licensed in any state. So no matter where you are, you can step in there. And, we have lots of them. There are some very long and very interesting discussions there. And otherwise, I look forward to seeing you all next week when we'll talk about the new developments here in the area of federal taxes.